Hello, welcome. Today we are going to start our course, the Portfolio Management, and this is the first class in this course. In this course we are going to discuss several topics related with the investment, how to make your decision in the investment for individual assets or for portfolio of assets. Recommended book for this course, Investment Portfolio Management. The book recommended is Investment Analysis and Portfolio Management for Riley and Brown. In this course we have 5 chapters: the investment setting, efficient capital market, and portfolio management. Also we will discuss chapter about an introduction to asset pricing model and multi-factor model for risk and return. So let us to start the first class in this course, investment setting. In this course we will discuss several topics related with the investment. What is an investment, return and risk, and determinant of required rate of return, and the relationship between risk and return. In beginning, what is an investment? The investment is related with an assets or item that is purchased with hope that will generate income. In order to drive future payment that will compensate the future, we need to focus on 3 points: time the funds are committed, expected rate of inflation, and uncertainty of future flow of funds. For that, when we are talking about the investment, by investing, saving money now instead of spending it, individual can trade off present consumption for a larger future consumption. An example for our investment, pure rate of interest. If you have now $100, if you can exchange $100 today for 100 for next year, this rate is 4%. 104 minus 100 divided minus 1 will be 4%. That means exchange rate between future consumption, future dollar, and present consumption, current dollars, the difference between 100 today and $104, that's related with pure rate of interest. When we are talking about pure rate of interest, we need to understand 2 points: pure time value of money and the effect of inflation. The first, the pure time value of money. In actual, people willing to pay more for the money, and lender desire to receive extra money on their saving money invested. In this case, we are understanding importance of time value of money. Also, we need to understand the impact of inflation on our investments. If the future payment will be reduced in value because of inflation, then the investor will demand an interest rate higher than the pure time value of money. Also, cover the expected inflation expense. Now we understand 2 points. When we are talking about pure rate of interest, we need to understand the impact time value of money and the impact of inflation on our investments. For that, we need to understand in this course what's the meaning risk and what's the meaning return, how we can to calculate the expected return, how we can to understand the relationship between risk and return. In actual, there's other name for the risk, uncertainty. When we are talking about the risk, we are talking about uncertainty. That means if there is uncertainty in this investment, that means direct there is risk. If there is more uncertainty, direct there is more risk. If the future payment from any investment is not certain, the investor will demand an interest rate that exceeds the pure time value of money plus inflation rate. Why? To provide a risk premium to cover the investment risk. Expected rates of return. What do we expect to earn? If you need to invest in any area, you expect it to achieve money, to achieve net income from your investment. In reality, most investors are more interested in the expected rate of return for future risky investments. If we have any investments, direct there is risk. That means an investor expects more return if there is more risk. Now, how we can to calculate the expected return? If you have investment, how we can to calculate the expected return and how we can to calculate the risk for the expected return? Again, any risk refers to uncertainty of the future outcomes for any investment. In actual, there are many possible return outcomes from an investment related with uncertainty. Probability is likelihood of outcome. The sum of probabilities of all possible will be 1. Now, how we can to calculate expected rate of return if we have investment in this area? The expected return equal summation probability of return multiply possible return. In actual, most of investment, there is risk in any investment, but some investment there is no risk. In this case, we are talking about perfect certainty, or we are talking about the risk-free assets. An example, if you invest in an asset that has an expected return 5%, then is absolutely certain your expected return will be 5%. That means there is no risk in this case. In this case, we assume there is no inflation, no uncertainty. If you estimated 5%, direct expected rate then will be 5%. While there are other types of investment related with risky investments. In actual, there are 3 possible outcomes. We suppose you are considering an investment with 3 different potential outcomes. In this case, we need to understand economic conditions. When we need to calculate expected rate of return, we need to understand economic conditions. We have 3 different potential. Maybe the economic is strong, maybe the economic weak, maybe there is stable in the economic. If we assume in a strong economy, the probability 15%, weak economy 15%, and stable economy 70%. In this case, we need to calculate expected rate of return multiply probability for each economic conditions to arrive the expected rate of return. In this case, we have 3 possible return and we have probability distribution for the risk to understand what's the meaning probability distribution. Now, when we need to calculate the expected rate of return, again, we can calculate expected rate of return for on a risky assets by expected return multiply probabilities. If the investment in risky assets with probability distribution as described above would have expected return 7%. This is higher than the risk-free assets. Look for this drive, we have 7%. This higher than risk-free assets with 2%. In other words, the investors get paid to take risk. In other words, for the risk rate with uncertainty of an investment. Therefore, the measure of risk should reflect the degree of uncertainty. If there is more uncertainty, there is more risk. An investment will reflect this risk. Risk of expected rate of return reflect degree of uncertainty that's actual return will be different from the expected rate of return. In actual, when I have expected for the return, I need to compare between expected return and actual return. The difference between actual return and expected rate of return, that's related with the variance, the volatility in the return. Common measures of risk are based on variance. Now we need to understand how we can to measure risk of expected rate of return. Again, common measures of risk are based on the variance of rates of return by distribution of an investment. Now, how we can to measure risk of expected return? In actual, we have many measures to measure risk of expected return. The first measure is the variance measure. The variance measure related with the difference between actual return and expected rate of return. How we can to calculate the variance? We can to calculate by summation probability multiply possible return minus expected rate of return square 2. The difference between possible return minus expected return square 2 multiply probability. That's variance measure. Also, we can to measure risk of expected return by standard deviation. Now, the variance summation probability multiply expected return minus actual return square 2. Standard deviation is square root of the variance. Standard deviation measure the total risk. Other measure for the expected return is coefficient of variance. Now, coefficient of variance measures risk per unit of expected return. Relative measure of risk. How we can to calculate coefficient of variance? By this equation. Coefficient of variance equal standard deviation of return divided expected rate of return. Now we have three measures for risk of expected return. The first, variance. Second, standard deviation, and coefficient of the variance. All these measures, we need to understand importance of risk. If I need to invest in any area, I will look for the risk. If there is more risk, direct. I need more return. Okay, today we explained many items related with the investments. We started with define what is investment. Also, we need to understand in this lecture what's measure for risk, how we can to measure the risk. In actual, this measures from any investments is not same. An example, if I need to invest in stock in banking sector will not be same if I need to invest in stocks in other sectors, because in banking sectors there is risk is not same with the risk in other sectors. For that I need to understand other type of risk that's called as premium risk. In next class we will explain what is premium risk, and also we will continue about how we can to understand the relationship between risk and return. Thank you for your attention in this class and see you in next class. Thank you.